Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Marc Chandler, managing partner at Bannockburn Global Forex. Now, Mark, let's start off with the data point that a lot of people were watching this morning, and that is the December payrolls number. The headline number showed a growth of 216,000 jobs. That was about 40,000 more than expected, but you look at the prior 2 months, those were revised down by a net 71,000 jobs. So overall, net, I guess you could say that this number was a little bit weaker than expected. We didn't see any movement in the unemployment rate, but that is because we saw a drop in the size of the labor force. So overall, Mark, this is really the first big data point of 2024. What did you see in the payrolls?
Thanks. Happy New Year, Corey. I think that I don't think we really learned that much new from the jobs data. I think we all knew the jobs market was slowing down. We saw that in the JOLTS data, the number of job openings, the number of people who are quitting jobs are falling, and I think that we just got it confirmed in the non-farm payroll data. Like you mentioned, the optics looked good, right? Non-farm payrolls up over 200,000. The unemployment rate was steady. But below the surface, I think people are concerned about a couple of things. Not only the constant or persistent downward revisions, but as you know, the unemployment rate itself is a function of the household survey. And the household survey was just miserable. Lost a few 100,000 jobs. And of course, it depends on what part of the report you want to look at. But I think that the takeaway doesn't really tell us that much new about the economy, and especially from the market and from investors' point of view. And what that means is that the odds of a rate cut in March are essentially unchanged on the day. So the market goes into the report thinking that Fed's going to be cutting interest rates as soon as March, roughly, call it almost an 80% chance. And that's what's still being priced in, almost an 80% chance the Fed delivers the first rate cut at the March 20th meeting.
Well, Mark, just in that regards, it seems like the focus will be shifting from the labor markets over to the inflation picture next week, not just in the US, but globally. What if the inflation number doesn't keep trending down like so many have just gotten used to? And what if we see an uptick in it? How would that affect the Fed policy moving forward?
That's a good point. I think, Chad, that part of it, and also tied back into the labor market number, is we did see the average hourly earnings rose a little bit more than expected. Many were hoping for a decline. Say many economists, not people who are receiving the pay, but many of the economists had been expecting the first break below 4% year over year increase in 2 years, and we didn't get that. Hourly earnings was a bit strong, and the reason this is important is not because of some kind of Phillips curve idea where large number of low unemployment rate fuels inflation because of wage pressure and that, but rather, I think what the Federal Reserve will do is they'll look at the hourly earnings and know that Americans spend what they make. And therefore, it's more of an idea that this points to stronger demand. And so we might see that, to your point, with the inflation data we get next week. And that inflation data, it's entirely reasonable to expect a small uptick in the headline rate. Remember, we had dipped down to 3.1% in November, likely to come back around 3.2%, maybe even a little bit higher. But the core rate, excluding food and energy, may still be declining. And I think that's what the Fed will focus on, is that's what the Fed targets the headline rate at 2%. They watch the core rate because the core rate is a true signal of where inflation's headed. I don't think that'll change very much. I think people will look through the headline increase in the CPI, focus on what still seems to be what they think to be a weakening of the U.S. economy, even though that's the other thing to point out. The Atlanta Fed's GDP tracker now is at 2.5%. And the importance of the 2.5% is that it is above what the Fed sees as the speed limit, the non-inflationary growth of the U.S. economy. So, bottom line here, as attention turns to prices rather than the labor market, we might get that news. The headline ticks up a little bit while the core rate falls. But net, I don't think it really changes expectations. I think we need to see we'll have to see stronger retail sales data. And of course, there's still a lot of data before the March meeting. And the December FOMC minutes showed that the Federal Reserve confidence in its outlook was shaky. It wasn't very confident, a high degree of uncertainty.
I find this so interesting because, look, the economy, it has been generally slowing, but it almost seems like compared to what investors are expecting and compared to what the Fed is expecting, the slowdown hasn't really taken hold in the same degree. Everyone seems to be expecting a broader slowdown in the markets. And then inflation, we do keep hearing that a lot of people are saying inflation is going to stay elevated, but again, most of the recent inflation data has shown that inflation is continuing to tick down. Why is the Fed and it seems like everybody else expecting something different than what we have seen in the data when it comes to economic data and inflation data?
Yeah, I don't know. I kind of want to say that the dismal scientists, I want to like give them more like a give them a wide berth here. Partly, we've had these for many people unprecedented shocks: the COVID, the lockdown, the reopening, the Chinese property market collapse, the war in Ukraine, the war in the Middle East. You've seen these pictures now of these ships avoiding the Red Sea, and so there's like right, you see these pictures. Every ship's like a dot, and you can see like nothing in the Red Sea, and all this like congestion again. And so, yeah, I think that we're coping with a lot of shocks, and I don't think the laws of economics or these regular patterns in economics have really changed. I don't think the business cycle has been repealed. I don't think that that relationship we're taught about prices and supply and demand has been changed. I think the law of supply and demand is sort of like the law of gravity. We might not like it, but it's there. And so I think that it's been a very difficult time to try to anticipate the economy, and I worry about ours as people's practice of or habit of falling back to priors. So people who thought that we had a couple of quarters last year where the economy contracted, and everybody thought it was a recession, including me. I thought it's 2 quarters contracting growth, even though it was mostly inventories and trade. And since then, the economy has boomed back. I mean, we're talking about almost 5% growth in Q3. And still, people want to to nitpick at the data and say that the economy is much weaker than it really is. And I think that's part of the challenge, which is also partly why around our forecasts, we've got to give ourselves like there's margins of error. And I would just say that the margins of error have increased.
Well, Mark, another thing we've seen if we look at just taking this over to the markets is the end of last year, a lot of anticipation in Q4 that Powell had pivoted, that the Fed policy will have all these rate cuts this year. There was kind of a sugar high rally in everything. The general markets, the general equities, bonds got a bid, cryptocurrencies got a bid, commodities got a bid. As we've rounded into the 2024 calendar year, we've seen a pullback in almost everything, and we've seen some of that enthusiasm tempered. Do you think that ties into the outlook on Fed policy, or do you think there's something else, like just simply profit taking or something else to explain the weakness we've seen to kick off here 2024, the January effect?
Yeah, Shad, I kind of thought that this was going to happen. I mean, I thought that the gains that we saw, so the gains in the foreign currencies, the rally in stocks, 9 weeks in a row in the S&P 500, and the sharp drop in U.S. interest rates was overdone. I kind of thought it was thin holiday market, say since the middle of December or so. A lot of senior people gone, means a lot of the Gen Xers or the next gens are running the show and press the trends. That's what they're incentivized to do. So I thought there'd be an unwind as we began this year. What surprises me is the volatility that we associated with today, with both in reaction to the U.S. jobs data and then that soft ISM services report. So we've seen a bit of volatility today. Interest rates began up by, say, call it 8 basis points or so, down on the day now. Dollar was strong. In fact, I was looking at the 5 and 20-day moving averages. We're crossing for most of the major currency pairs. And now only about half of them are crossing, given this volatility we've had in the dollar. So yeah, I think it's really more a question of market positioning rather than a real change in fundamentals.
So, what about market pricing and what the Fed is potentially going to do? We were chatting off mic about how the market was pricing in 80% chance of a cut in March and still pricing in, I believe, over 5 cuts for this year. However, it seems like the markets have always been, in a way, pushing the Fed towards an easier policy. But we do have QT ongoing, which no one seems to be talking about. So, how do you correlate, again, what markets are pricing in, what the Fed's going to do, and how markets react to the changes?
Yeah, so what I like about the markets, especially as they've evolved in the last decade or so, is that we live in a probabilistic world that the markets recognize. So we can talk about the odds of something taking place, not just it's not just on or off. It's not just it does or it doesn't. And so you're right that the market still is fairly confident, almost 80% chance of a cut in March. And I think that the first cut or two from the Fed won't be packaged or spun or explained to be a rate cut or an easing of policy. As you noted, the economy is not so weak after all. Instead, they're going to say, I think the argument is going to be something like this: we're going to cut interest rates to maintain the level of restriction, given that inflation is falling. And the problem with that idea, which I think is going to be widespread, I think that's really the conventional view. The problem with that is what Powell identified in the fourth quarter last year, talking about the need for persistence. When he talked about the financial conditions, he wants persistency. And we've seen a bunch of short-term developments. And so I would want to take the low rates to be the sign the Fed was about how bearish the market was on the economy or what they thought about Fed policy. I'd want to use some kind of like average to figure this out. But to your point, the market is pricing in a very aggressive Fed easing cycle with the I'd say 2.5 cuts priced in for the first half of this year. And that seems to me, well, it's possible. I just wouldn't assess the odds so high. And I think that what happens then is that the economy shows a bit more resilience. I think that, this is the fourth year of the U.S. presidential cycle. And typically we don't have a recession during an presidential election year. The recession typically takes place in the new person's term. It takes place early in the first term rather than late in the first term. And so I think that the risk is that the economy slows down, maybe not as fast. Maybe you don't get to below trend growth to the second half of the year. And I would look for the dollar to generally to trend lower more in the second half of the year. So I still think there's a little bit more room for the dollar to correct higher after that big shakeout at the end of last year.
Well, Mark, let's unpack that a little bit more about the dollar, like you mentioned there at the end, because you are a resident currency expert, and it brings into picture not just the health of the U.S. economy and what the Fed policy is doing in interest rates, but it also brings in a wider scope of the global picture, what's going on in other countries, what's going on in their economies, how do those currencies react to the dollar? How are you looking at the currency markets as we roll into the first quarter of 2024?
So I'm in the camp that thinks that the dollar made a big high back in the late 2022, and it had come off until or in the early part of last year before the rally, and that rally was driven by divergence, while the U.S. economy was growing well above trend, while Europe and Japan were contracting, and that carried through into towards late last year. And I think that as we begin this year, people were thinking that we're going to have a new convergence. And the convergence wasn't going to be that Europe or Japan caught up to the U.S. in terms of growth, but rather the U.S. economy was going to slow down. And so I think that was I think the big picture was priced in. And now I think the market's just got to reconsider. And partly, like I said, partly market positioning, and partly is, will the U.S. economy outperform? Not just in Q1, but will it continue into the second quarter? I think that's the key question. My general sense would be that we might get this dollar bounce now, but I think the dollar ends up continuing to trend lower as the market will, as the Fed will come around and cut interest rates, and we'll see the QT, which is another form of tightening that Corey mentioned. We will see that wind down as well. I'd be watching those the volume that's going through the reserve repo facility of the Fed, and as that continues to fall, there'll be more pressure for the Fed to first taper and then conclude the QT. And I think we can see that begin happening around middle of the year or so.
So let's talk levels then for the dollar, because if we think about it, the dollar entered 2023 at about 103 and broadly traded in, I guess, a fairly wide range for the dollar, going down to about 99, high 99, and then up to 107. We're ending the year right at the bottom part of this range, but how much lower do you think the dollar could go this year then?
So yeah, I'm thinking that we saw that high last early October, like you mentioned, around what was that, around 107.5. And so I think we've had the first wave down, the first big part down. I think that's why I think we're in an upside correction here. But the next leg down, I think, takes us down towards 98, maybe 97. Maybe we could finish the year closer to 95, 96. So it's not a huge move, but it's just what I'm really looking at is the dollar index finishing continuing and possibly finishing the correction from the bounce that we saw And remember, it began January 6th, which many people remember for other reasons, but January 6th, 2021, dollar index bottoms. And I think that we've already seen a big leg down in that. We've been trading broadly sideways, I'd say choppy way in 2023, and I look for one more leg down here in 2024.
Well, Mark, if we do have one more leg down in the greenback, then what does that mean for gold that's held up pretty well the end of last year? It was at all-time highs to close the year. Pulled back a little bit to start the year like everything else, but usually a weaker dollar is a good thing for gold. How are you looking at the precious metals market?
Yeah, isn't that amazing? Just the spike in gold we saw, record highs, 21.35 in the cash market in early December. We've held up pretty well here. I think you're right. I know that a lot of people talk about the central bank buying of gold, and I don't know what to make of that. I mean, I don't know if that's really the driving force of gold. In the short terms, in the short like little sort of pockets of time, I can look at and understand how gold is moving. I do think you're right. For me, you tell me the direction of the dollar, the direction of U.S. interest rates, and I could have a pretty good guess the direction of gold. And because of that kind of like that perhaps simple view, and I'm thinking that the dollar and interest rates softened this year, I have gold going higher. I wouldn't be surprised to see something closer to 2,200, especially given the fluidity of the geopolitics too. I think that was part of gold's rally late last year. We were talking about before with the Red Sea, Middle East developments. Ukraine situation, I'm afraid, is going to get worse. There's other sort of frozen conflicts that are melting, that are beginning to like flare up, I should say. And I think all this favors gold. And so, yeah, that's why I think that we could see another maybe 2,200 or so, 2,250 maybe even.
All right. So I guess looking ahead then, we have just started 2024. And again, we just got that jobs data. Next week, it's a lot of inflation data. So what are you going to be watching out for, Mark?
Yes, so I'm looking at not only the U.S. CPI, Mexico has a CPI. Mexico is one of the few LATAM countries that haven't cut interest rates. I think a softer core rate, get that back on the on radar screens for a Mexican rate cut, at least one before the election, possibly two. Their election's in early June. China also has a CPI and PPI. We're probably looking at slightly less deflation there, but I think that China has signaled a rate cut, not next week, but that following week. They had provided some funds to the banks at the end of last year below their like floor, which is set at their 1 year medium term lending facility rate. And so I look for a rate cut from them after we see their CPI still below zero. We get the Tokyo CPI as well. Tokyo CPI is a good guess for the nation CPI. And we're going to see that the Bank of Japan is under very little pressure to have to change policy. Some people thought it could happen in January. I lean towards late April, after the spring round of wages, after the government releases or cancels, or I should say the subsidies for energy and gas expire. And so all these things, I think, contribute to the Bank of Japan moving later rather than sooner. And the big earthquake and just the danger, the damage done, and just the tragedy of that earthquake and tsunami in Japan, I think also means the BOJ under little pressure to change rates. And they'll see that with the continuing fall in headline and core Tokyo CPI.
All right, Mark. Great chatting with you. Thanks for taking time early in 2024. We'll be chatting with you throughout the year and seeing if, again, that dollar continues to weaken. And most importantly, it seems like for the markets, what central banks do throughout this year. A lot of question marks around that, but it does seem like we are going to get a generally easier or more dovish policy from almost all the central banks. It's just on timing now. Mark, thank you for your time. I hope you have a great rest of your week. We'll chat again next week.
Thanks. Good luck. Have a good year, everybody.